So a couple of years ago, I met with two doctors who got a bad deal with whole life insurance. They were putting $100,000 per year into each of their policies. So it's a total of 200K per year. Now, why they got a bad deal is because if we take one of their policies, 100K per year went in the first year, they had about $50,000. And as they pay 100K every year, by the 10th year, they would have paid $1 million. And then at that point in time, they finally have $1 million. Meaning for the first 9 years, they were running a loss. They might have been positive by year 8 or 9. But my point is, they took a 50% loss in the first year, and it took a long time before they saw any real buildup in their cash value. So they didn't like it. They questioned the agent and said, why was it sold this way? Couldn't understand it because whole life insurance can be confusing. So met with them. To make a long story short, what we did was look at new policies for them where they paid the same dollar amount in, $100,000 per year. However, it was set up where instead of having $50,000 in first year cash value, they had about $90,000 in first year cash value. The difference was, of that $100,000 payment, only $10,000, which was as low as we could set it, went toward the premium, and everything else went into the PUA rider, which stands for paid up additions, which maximizes the cash value. So they liked this because they had more cash value up front. They had a positive return between 3 and 4 years instead of 10 years. So that was a lot more attractive. But the thing that they liked the most was they recently started their own practice and they didn't want to be on the hook for a big premium bill every year. So with the new policies, aside from having more in cash value, they're set up where they're only committed to $10,000 per year in each of them, where before their minimum was $50K per year in each of them. So think about that. Combined, before it was $100,000 that they were obligated to write a check for every year. Now it's $20,000 between the both of them. But now they can also stuff the policies with extra money, which build the cash value. So their stress levels, which were originally up here, came all the way down here. And I think that was like the number one thing actually that's most important, because when it's your money that you're dealing with, the last thing you want with a product that's supposed to help you is to be stressed out because it's not working or it feels like a burden. It doesn't work. Like even if the returns are fantastic, if it stresses you out, you're not going to want to do it. I wouldn't want to do it. So just by going through how a policy can be set up, how to keep their minimums low, how to make it flexible where they can add money at their discretion, how the loans work. They recently reached out and said, we're looking to buy a car for the company. How do we do this right so we can book it as a business loan with our accountant? So we went through exactly how they could do that. And now they're in a position where they're not stressed out, their money's actually growing, and they can use it for their business and their personal life as time passes.